The broadcast is now starting.
Hi everyone, and thanks for joining us today. Today's webinar will be presented by Aleks Vickovich, Managing Editor of Advisor Innovation. Before I introduce today's speaker, I'll just do a little bit of housekeeping. So this webinar is being recorded and the slides will be sent to you after the webinar within the next week. We encourage you to ask any questions you have throughout the presentation, and Aleks will endeavour to answer them all at the end of the webinar. If you're posting to social, make sure to use hashtag NetwealthInvest or tweet at NetwealthInvest. And as always, there is one CPD point available and the questionnaire will be sent out to you early next week. And now to introduce today's speaker. Aleks is Managing Editor of Wealth and Innovation at Momentum Media, the publisher of Advisor Innovation. He has been covering financial services with a focus on non-aligned advice for 6 years. I'll now hand it over to Aleks. Thanks, Aleks.
Well, thank you, Leah, and thank you also to Netwealth for this webinar series and for supporting quality content and thought leadership in the financial advice community. Given everything that's going on, I think we really do need an open dialogue and frank discourse in the industry, and it's great to see product providers facilitating that kind of discussion, which hopefully we're going to be having today. Great also to see so many of you registered, which of course means that you're not over on investordaily.com.au following the live blog of the Royal Commission. So stay tuned with us for an hour and then you can head back over to Investor Daily to follow proceedings throughout the day. I'm going to be sharing with you some insights about what's going on in the American wealth management landscape and what you can learn from it, because I think there truly are some significant takeouts from the experience of your American peers over the past decade or so, and what you're experiencing currently and I believe into the future as well. So we're going to do a little bit of reading the tea leaves. Arguably, we're having our own 2008-2009 moment right now, not in terms of investment returns or the shape of the market, of course, but in terms of the financial system's poor standing with the broader community, which is, of course, being exacerbated by the Royal Commission. And I think it's worth, casting your mind back, 10 years ago, almost to a month. So September 2008, we saw the collapse of Lehman Brothers and the subsequent financial crisis. And that was really significant, not just for the world economy, but for the American advice industry and financial services, because it really was the first time that the American public lost faith, certainly since the Great Depression, with Wall Street's ability to protect their assets. But overwhelmingly over the last 10 years, despite that kind of malaise, the industry has regathered. It's made some changes. It's shown itself to be willing to adapt to the external things that are being thrown at it. And really, it's done that through the adoption of innovation. That's been one of the main things that has allowed it to thrive. So I think there's a real relevance in the United States at the moment for all of you listening. And so I hope that this conversation is not just informational, but inspirational. So on that note, why are you listening to me and how do you know anything I have to say is of any value? Well, of course you don't. And I want to disclose at the outset that I'm not an expert in these topics. I'm certainly not an expert in artificial intelligence or these technologies that are emerging. I'm a journalist and I know the things that I'm going to be talking about simply because I've asked questions and received answers and covered this space for a number of years in both countries. So I don't have any degrees in quantum computing and I've never given a TED talk, but I did spend 2 years in the United States talking to and writing about financial advisors as well as fintech entrepreneurs in New York, in Silicon Valley, and in the emerging hub of Austin, Texas, which certainly you're going to be hearing more about in future years. And I also took the pulse of the broader national mood and covered the 2016 US presidential election, which I write about in my book, USA G'day. If you're interested in that, you can check out usag'day.com or search for USA G'day on Amazon. I was also the MC, along with Netwealth Joint Managing Director Matt Heiner, of the recent Netwealth study tour to New York City, which really cemented for me some of the findings in this presentation. I'm going to be bringing to you some of the highlights because a lot changes in the 12 months since I was last there. And this really does show the rapidly changing world of innovation in financial services and wealth management. So before I get on to some of those more substantive topics, I just want to set an overview of the US advice market so that you're sort of understanding the lay of the land over in the US. So let's start with regulation. Of course, a logical place to start. And even though the US market is arguably less regulated than the Australian market, I think most American advisors would still say that this is their major pain point. They might also say that in recent years they've been used as a punching bag, they've been blamed for misconduct that actually occurred further up the value chain and was really caused by the Wall Street fat cat. So I'm sure that's a story that sounds familiar to many of you. Now, regulation, while, as I said, is arguably less than what we see in Australia, it has substantially increased in the United States following that crisis in 2008, 2009, under both the Bush and the Obama administrations. Now, basically, if you're an investment advisor or a financial advisor in America, you've got a choice. You can either be a broker-dealer or you can be a registered investment advisor. Now, broker-dealers, a few key facts about them. They're basically kind of a cross between a stockbroker and I guess a kind of institutionally aligned restricted APL style advisor in Australia. Importantly, they're regulated by FINRA, which is a self-regulatory organisation. It's not government. It's kind of what the FPA and the CPA want to be, I guess, kind of like the Law Society of New South Wales is, where it actually registers and monitors the industry. Now, the criticism of FINRA is that it's too close to the big end of town. Having said that, in 2017 alone, it did hand down 492 banning orders, 733 suspensions. So it is very active, but it's not a government entity and comes with all of the criticisms of being a self-regulatory organisation. There are also independent broker-dealers, which is kind of a dual model, but that really, I think, just shows how much opaqueness and greyness there is in their regulatory system, just like there is in ours. Now, registered investment advisors, by contrast, are regulated by the SEC, the Securities and Exchange Commission, which is basically a scarier, better funded ASIC. It's a government entity, very, very powerful. Now, if an advice firm has less than 100 million in funds under advice, it gets regulated by the respective state regulator in the state where they're domiciled. So this kind of dichotomy between the broker-dealer and the RIA, as they're termed, has really been the traditional structure in the advice industry. Another really key difference between the two is that broker-dealers are subject to a suitability test, RIAs to a fiduciary duty, so similar to FOFA's best interest duty. Sometimes RIAs are termed fiduciaries, or they call themselves fiduciaries because of that fiduciary duty. And when you ask around the differences between these in practice, it seems to be very stark. I spoke to one Wall Street lawyer who explained to me that as long as somebody has a pulse, then a product is suitable under the FINRA suitability test. So fairly low standard that they're meeting perhaps on the broker-dealer side. Which is why I'm going to focus a little bit more on RIAs, because I think they're far more analogous to those of you listening and to the Australian experience. More client-centric, more regulated, and beholden to a best interest duty. Now, as I said, that dichotomy has been the traditional structure. The Obama administration did try to change this with the introduction of a new rule, which would make all advisors, whether they're broker-dealers, RIAs, regardless of their regulatory status, subject to a best interest duty. There's been a big fight about this in recent years. The institutions and their lobbyists were, of course, very resistant to this. And then we have a very unorthodox president now, of course, in the White House. The ball is now in Donald Trump's court. And he's been a little busy in his first 2 years to deal with this issue, but he has generally favoured a deregulation approach, except on the issue of trade. So unlikely that this fiduciary rule would be a priority for him. So as I said, we're going to focus on RIAs, and this group of the advice market, it's still a minority of American advisors, but it's the fastest growing by a country mile. And what we've seen over the last 10 years, and particularly in the last 2 or 3, is this fairly significant migration away from the major Wall Street wirehouses which are, household names: Morgan Stanley, Wells Fargo, UBS, Merrill Lynch, Bank of America. These wirehouses traditionally held the majority of broker dealers. The majority of investment advice was through these entities. And what we've seen is a real fragmentation, a revolution where advisors have left, they've gone independent, and they're setting up their own shops under independent brands. So I think that's something that we are really seeing at the moment in Australia, with the move away from the institutional licensees, of course, the banks themselves getting out of the business, and of course the proliferation of self-licensed practices across the country. So that sort of sets the scene there. A little bit of more detail on just the RIA revolution and how successful it's been. So there's around 64,346 RIAs, individual RIAs across 18,225 firms. So compared to the Australian market, that looks significant. Worth keeping in mind, that's still probably only about 15% of the total American market, depending on your definition. The RIA market now has 4.1 trillion in assets under management. So, that's substantial. That's twice the size of the whole Australian superannuation assets. So it really does just show, the real scale of the American market and just how much funds under management there is in the United States, given to its population, of course, and the economic growth it's experienced over the last 100 years. Now, this graph shows some specifics around that growth, the compound annual growth rate in funds under management, revenue and client numbers in just a short amount of time, 2012 to 2016. Fairly significant jumps there. This is from the Charles Schwab RIA benchmarking study, which will cost you a lot of money if you buy it on the open market. So you all owe me a couple of beers on this one. The second graph shows how importantly RIAs are not just taking the greatest share of FUM, but they're taking the greatest share of FUM with the high net worth investor. So not too long ago, your wealthy American families are far more likely to be advised by these major Wall Street firms. Not so anymore. A lot of them are now with smaller brand IFAs, or RIAs as they're termed. A few attributes. These are just based on my own personal experience of interviewing them, and a lot of overlap, again, to the sorts of advisors that really are probably listening into this webinar. They're fiercely independent. They're skeptical of institutions in general. A lot of them are suffering some sort of trauma based on their experience of having been restricted and having been pushed into a sales model within the wirehouses. So a lot of overlaps there. They're backed by private equity. That's a really important sort of subplot of the rise of RIAs. They have received a lot of capital from investors who are simply bullish on the rise of this independent market. And sometimes they come from financial services backgrounds, sometimes these investors don't, but they're really just voting with their feet on this RIA movement being really substantial. And that's been really important because traditionally for independent firms, just like here, a lot of the people that are offering the money and allowing them to grow have some sorts of conditions. They might be product providers, they might be an ulterior motive, but when you're dealing with pure private equity players, really they just want to see a profitable firm. So it allows the kind of independence that these firms are after. I believe that we'll see a similar thing in Australia. We're already starting to see it with the entry of Focus Financial Advisors, Focus Financial Partners into our market, which is a big private equity-backed US wealth management aggregator. We're also seeing it with Paul Barrett's operation, AZNGA, which of course has made pretty big acquisitions using Italian private equity money. Firms like Henderson Maxwell, Eureka, Whittaker Macnaught, well-known Australian firms now backed by private equity and moving independent to some extent. So I think that's a key takeout. 90% or more of RIAs charge on an asset-based fee. I'm not going to get into a debate or a discussion here around performance-based fees, asset-based fees. I'll leave that up to you to decide what model you're into. But I note that a lot of Australian firms are moving away from this model, perhaps anticipating some regulatory change down the track, particularly if Bill Shorten is our next Prime Minister. But 90% of RIAs, despite their independence, charging asset-based fees. Just an interesting point on that. The low-cost passive investment movement, ETFs, really in vogue there, really I think stems partly from their negative experience of dealing with Wall Street and active managers. And the other thing that's really important is that they are really heavily reliant on their custodians. The custodian really plays a role that the platform plays in Australia primarily, but also partly the dealer group, because these custodians, which are well-known brands, State Street, Pershing, BlackRock, they're sending, practice management consultants out across the land. They're really investing in content, in community, and they're really in some ways forming the role of the traditional dealer group in Australia. And I know that some more innovative product providers in Australia are also doing that, similar to Netwealth. I'll get to this topic in more substantive detail because it came up on the Netwealth tour, but they're really embracing honest value propositions and marketing. So what I mean by that is, they're not shying away from the bits that they really excel in and the bits that they don't. If investment management is not their forte, then they're being really upfront about that, and they're bringing fund managers into the picture. They're explaining to their clients why they're partnering with investment managers, and they're focusing on the client piece. So I think they're really being very effective in transitioning to a more client-centric approach, and they've got the marketing and the communications to back that up. So we'll talk about that in a bit more detail. And most importantly, they've been willing to experiment with fintech. They've been willing to look at robo-advice and not see it as a competitor, but to build it into their website as a tool for example, raising the number of next generation clients and really helping them deal with and master that generational wealth transfer that's going to occur. So they're watching what's coming out of Silicon Valley, and they're not saying, this is disruptive, this is worrying. They're saying, how can I incorporate this into my practice? Granted, they've probably got less of a compliance burden than those of you listening, but I think that mindset of looking at what's coming out of the technology entrepreneurs and seeing how it's relevant to your practice is very relevant indeed. So I'm going to move on now to the Netwealth study tour, which really focused primarily on this question of how Wall Street, but also how financial advisors are reacting to this Silicon Valley innovation and this disruption. Advisor Innovation was a media partner for the 2018 tour. We had 30 speakers over 3 days. So the days of junkets in financial services, of course, well and truly dead. It was very hard-hitting content. I'll bring you some of the highlights of that now. And as I said, there's really this client-centric innovation is what came through. So I'm going to start with artificial intelligence. And as I said at the outset, I'm not an expert in this topic, but we did speak to somebody who is an expert in this topic, who was Jared Franz from Capital Group, who of course are an investment manager, New York-based, operating now in Australia. And Jared really he's an economist. He took us through from a very broad level where he sees the AI discussion at. And he was very blunt. He said, if you're not doing it, you're being disrupted by it. So really, he was saying you need to be across this. He's very, very bullish on this. He's describing it as the fourth industrial revolution. He spoke about Moore's law, which is a very old concept in science. It essentially talks to this idea that computing power and processing power really increases exponentially over time. So using Moore's law, he asked, is AI becoming so intelligent that it may surpass human IQ at some point? And really, he said where AI and where artificial intelligence is doing very well and where the human will be unlikely to be able to compete is on pattern finding and prediction making, both of which, of course, highly relevant to the investment management process. But he said that he was expecting a lot of disruption of labour markets. We asked him around these sensitive questions around job losses and the political ramifications, social ramifications of this. And his quote was, he said, the economist in me says people will lose jobs and then simply retrain and get new jobs. But history shows us this is not always the case. So he was very forthright about, he thinks ultimately there will be an impact and hopefully, people in low-skilled manufacturing jobs and even professional services will be able to retrain and adapt to the AI world. But he did make clear that disruption is on its way. But finally, he said that, and we hear this a lot, and I think it was important to hear it from someone like him. He thinks what it will ultimately do is it allows human professionals and human service providers to focus on the human elements of their work. He went further than that. He said AI is going to make us better humans generally because it will allow us to be more connected. It'll allow us to spend less time in admin roles and more time in caring relationships and customer service roles. So I think the takeaway for advisors from this sort of broad discussion on artificial intelligence is that if you utilize this technology, it'll help you better know your clients. It'll help you better service their desires and their needs, and it'll make us better value our humanity, which is really, I think, increasingly the most profitable part of an advice firm into the future. So we then heard from Watson, IBM Watson, probably one of the more interesting and early adopters and sort of pioneers in the AI space. For IBM, AI is not artificial intelligence, but augmented or assisted intelligence. So really, it does see this technology as a conduit to the professional. They've moved into the wealth management space to some extent, but importantly, they said we still see the human being as the center of financial planning. Now, as I said, they have gone into this market, but really wealth management is a very small part of IBM's total remit. So there's no reason why our speaker, Rob Stanich, would be sucking up to us or giving us information that IBM truly doesn't believe to be the case. So to see a giant like IBM bullish on the future of human financial advisors was something that really resonated with our delegates and something that I think is very important to note. He said that when it comes to wealth management itself, what Watson does is it helps advisors predict client movements into the future based on their behavior. It helps them attract ideal clients as well. And when it comes to this idea of melding AI and the human advisor, which is something that came through a lot throughout the tour and throughout my discussions with people that are really experimenting with this technology in the United States. Rob and his colleagues gave the example of WebMD and the GP. People use these online Dr. Googles, but that doesn't mean that they don't have a doctor. And in the same way, Rob sees the future consumer of financial products using robos, using artificial intelligence, being tapped in to these technologies, but still using a human advisor for those more high touch elements. And it said what consumers ultimately want is a combination of high tech and high touch, which I think is a great line that should really be a takeaway for you. So segmentation was really the thing that came through from them. It allows you to tailor your services to the clients over those life stages. So clearly IBM is making a pitch to the industry that AI is their friend. And this is something that we heard from them and something that we also heard from Peffin, who is a really interesting development. They've only launched in the last couple of years, really in the early stages of development. They describe themselves as the world's first AI financial advisor. Look them up on Google. Really interesting story and really interesting founder, Ramya Joseph. She was a Goldman Sachs exec. She decided that she didn't want to help millionaires anymore. She just wanted to help people like her dad retire. Of course, many of you listening would share that aspiration, but arguably the FOFA reforms have not made that very easy for you. We'll leave that aside for now. Now, she has been slightly critical of Watson, the last case study that I took you through. She said that if you look at Watson, they don't tailor the solution to you, it's just general advice. So what they've done is they've taken AI and they've moved it more specifically into the financial advisor's process. And they use feed-forward neural networks, which are basically a computer system which learns, which is really the heart of where AI technology is at right now. The ability for computer systems to learn from the behavior and learn from the inputs that are being put in, rather than be directed entirely by the human manipulator of that technology. And Peffin's technology is designed to be personalized and fiduciary. It's designed to act in the best interests of clients. So when they took us through a demo, the advisors who were with us found it pretty scary, to be honest. They were impressed by what they saw, and so was I, frankly. It is very user friendly. It really does tap into some deep psychology using this technology. But having said that, we asked Ramya, do you agree with the others that we've spoken to? Is there a role for financial advisors, or are you going to knock them out of the park? And she said quite simply, most of our users have financial advisors. So she again agrees with this idea of high tech and high touch, and the ability for AI to be a tool. If you go back to Jared Franz's comment, of course, if you're not using it, it's going to disrupt you. Second real topic that came through is this whole idea around content, marketing, communications. I think really important in the current environment. I've spoken to a lot of advisors who have asked me for my advice on how you frame this Royal Commission discussion with your clients. And I think, depending on who you're aligned to, that can be more difficult than for others. But I think it really does come down to authenticity. And that's something we heard from our speaker downtown, Josh Brown. He's probably the US's most successful financial blogger, to the extent where his financial planning practice is now using the blog as a source of revenue. It's advertising. So essentially, he's become traditional media to some extent. He is a really interesting guy. His Twitter handle is @ReformedBroker. I suggest you check him out. He was a Wall Street hotshot, a broker back in the heyday, a Wolf of Wall Street type who really had an epiphany. Like Saul on the road to Damascus, he saw the light, and he became an independent financial advisor, an RIA. Now he is one of the directors of Ritholtz Wealth Management, but really he's better known as a blogger. And that's why we got him in, because we wanted to say, hey, you're an advisor, you've got the same skills as these guys. Why is your blog so successful, and why have you been able to manage and do so well with these communications? And what he said was, authenticity is what matters. He said, please do not go out there and get an external PR consultant. Any authenticity you have will be ruined by that traditional media world. And I think that's a really interesting point. So for any of you thinking about that style, authenticity is something that he says is really, really important. He also said that, people want to read something from somebody actually doing the thing. They want to hear from the advisor. They don't want to hear from someone who simply can write well. So he said, if you're thinking about going and hiring a journalism grad or paying someone to do the writing because they can write well, he said, you're undervaluing the worth of having the experience. Your most experienced people should be the ones doing the writing. The 3 rules of financial blogging: accuracy, compliance, and helpfulness. And he said, really, your opinions, your investment philosophy, your approach to your work should be what shines through. Don't allow it to be stage managed. I think really important message there is that, in the age of fake news, trust in the media is low. People are looking for experts, but not if they sound like wankers, frankly. They want people to talk about their experience. So I know a lot of people do struggle to put pen to paper. Little tip from me as a content producer: go into a room, get the topic that you want to talk about, take one of your fellow advisors or somebody from your business, have a back and forth conversation like a podcast, record it, transcribe it, and you'll find you've got plenty of content there that you can use for an article. If you're dealing with writer's block, that's a little tip from me. So I think this was a really important message from the king of content, that content is king. We spoke to another Wall Street exec, and I think Josh Brown, like this guy, Rick Capozzi, really interesting in that these guys are really the traditional financial services market. Rick Capozzi, former senior head of sales at Morgan Stanley, UBS, and Wells Fargo. He's a serious Wall Street guy. He looks like one, he talks like one, but he has also really seen the light and moved to this he now travels the world giving speeches and writing and doing white papers for advisors around how their worth is in the human relationship and in the strategic advice. It's not in wealth management. He says, everyone claims to be in the wealth management business. That's a myth. True wealth management is where the growth will be. The investment person is losing market share. So I think this is something that we are hearing a lot, but it's really important to look at who is saying this. And clearly Rick's colleagues over at Morgan Stanley and so on, might not be too happy to hear this sort of thing, because they're moving more slowly than the RIA or the IFA practice can on this. For him, he says the holy grail is recruitment, retention, and culture, going back to the basics of management. And he says you need to hire good people in order to really help you transition from being a financial product vendor to a true wealth manager, which is something that that really, you know, is relevant to I think to all of you listening. That process. Many of you have gone through that, or you've worked in firms that have gone through that over recent years, before FOFA, after FOFA, and as we go through the current climate. So, financial life management. I don't know if any of you are familiar with this term. It's certainly something that's trending in the US market. And it's a trademark term, but it is used in Australia by a firm called Tracer Financial Life Management, who United Capital gave express permission to them to use that term. Really, what this is all about is the idea that wealth management should not be about maximizing net worth. It should be about helping people reach their goals, regardless of what those goals are. I've interviewed Joe Duran, who's the sort of thought leader and founder of United Capital. Really interesting guy. I know there's a lot of talk back and forth about goals-based. Everybody says they do it. What United Capital does is really extreme goals-based, to the extent where, in Joe's view, if somebody comes to him and says, I want to blow all my money traveling around the world over the next 6 months, and that's in line with their values, he would advise them to do so. Not many people listening would necessarily think that's sound financial advice, but Joe talks about it's all about maximizing lives, not maximizing wallets. And he says the whole industry is predicated on this whole preconceived notion of increasing the pool of assets and helping people retire with a ton of money, or die with a ton of money, more likely to hand over to their dependents and beneficiaries, and he is against that. So you might think he's out there with this approach, but what's been fascinating is that, you know, his firm has grown from, you know, he's from Rhodesia. He came to America with about $400 in his pocket. He now sits at the helm of a $16 billion funds under advice independent firm. He attributes the growth of that firm to that philosophy, to that kind of idea of our job is to manage your financial life, not to manage your investments. Joe also, really importantly, spoke about the impact that Vanguard and that kind of price war, that race to the bottom on fees and the whole low-cost investment environment, the impact that that is having on the market. He described them as the Amazon of financial services, saying that they're going to take it all. Joe Duran, 6 Steps for Future Success. Really interesting guy, at Duran Money, if you want to follow him on Twitter. He says, live with your clients, live where your clients do, rule number 1. Now, this doesn't mean that they're geographically close. It means that you need to be using the technologies where they are. The average adult spends 5 hours on their phone each day. People trust Google more than the word of their own friends. So advisors need to be living where their clients are. You need to be mobile first. You need to be operating on the same platforms that your ideal clients are, whether that's Facebook, Instagram, Twitter, or whatever the future may hold on that front. Rule number 2, live where your clients' lives and money intersect. So he talks about how do clients want to live? What are their goals? How can advisors help them reach those goals? So he says that this is where the advisor really adds value beyond what a robo-advisor can, balancing these key concerns and helping them really achieve happiness as a goal in their lives. Third question, answering the question, am I okay? Joe Duran believes this is the main reason that any client goes to see an advisor, to reaffirm that they can live the life they want to, and to make sure that they're on track. He says it's important to remember that client goals don't stay the same, and that really what they want is peace of mind. And that, again, goes to this human element that is really coming throughout all of the more forward-thinking people that I've interviewed and that I've spoken to over in the US. Number 4, be a coach and guide. And this, of course, is stuff that many financial advisors in Australia have really taken to and been pioneers of as well in recent years. But worth noting that this is, what is really what successful firms in the United States are doing. Be a guide and coach. Joe says that practically every plan offered by an advisor is wrong by the time it's implemented, yet clients are still charged. Why? Because they're really paying for the changes and the updates being made along the way. So again, he's challenging some of the preconceived notions of the industry, that idea of the investment manager and the expert. Instead, he's focused on that financial life management. 5, charge for what clients really value. He said, fees have become a really contentious issue through the Royal Commission in Australia, through scandals in the United States. But the critical component, according to Joe Duran, is that the clients are charged for the services that they most appreciate. And of course, services that they receive. If you're following the Royal Commission live blog, you'll know what I'm talking about there. And number 6, practice at the top of your license. So you need to focus on your core competencies. You need to focus on the bits that you're truly good at. For many of you, he believes that is the client piece. That is the relationship management. It's the strategic advice. It's not the investment management. It may be for some, but if it's not, be willing to outsource. So he's very, very big on this world of business process outsourcing, even investment management outsourcing, and focusing on your core competencies. So Joe Duran, really interesting guy. I suggest you check out. Somebody who I think embodies the independent revolution in the United States and that move away from the Wall Street powerhouses. Just finally on big data, I'm going to look at that briefly. Big data is a term that gets thrown around a lot. Big data is small data. That is, I think, the point that is most relevant for financial advisors. And that is the point that was made by Boston Consulting Group, which is obviously a very influential management consulting firm that advises CEOs and governments around the world. They made the point to us that small businesses around the world are sometimes the richest in data. And wealth management firms, financial advice firms, that is particularly true of. I mean, apart from your local GP, you probably are sitting on more lucrative data, more information about your clients than any other kind of firm of your size. And from BCG's perspective, and from my perspective, I think that really is a core strategic asset. It's something that you really have in your favor. The banks do have a lot of information, but it's slower for them to analyze this stuff. Technology is emerging that is allowing you to really utilize that. Watson, for example, which I touched on before, scans the social media accounts of clients in order to work out what life stage they're at and what sort of advice they might be needing. So there was also some, when it comes to big data, you need to be really aware of the compliance and the regulatory environment. Obviously, looking at the Facebook scandal with the use of their customer data, this is a really hot topic, and it's only going to get more serious. And Neil Bartlett was one of the speakers that we spoke to on the tour. He's from the Royal Bank of Canada in New York. And Neil Bartlett says there's a really simple, arithmetic that you should use when you're talking about the use of data in your firm. Is your use of client data creepy or cool? What are you trying to do? Is it in the best interest in clients? And frankly, would you have a problem with somebody else using your, accessing your private information in that way? So essentially, if you're using data to improve the lives of your clients, to run a better financial plan and to give them better advice, then that's probably a good use of the data that is at your discretion. Of course, you need technology to do that, and that's emerging, and you can speak to people like Netwealth and other experts out there about what they're doing on the data front. But we spoke to a lot of advisors, 2 advisors in particular that we met with, Jason and Jeff, said that data aggregation is the major thing that they're really excited by in their business. Not something that I've heard from a lot of Australian advisors, but you are sitting on a lot of data, and you need to realize that that puts you in a really good opportunity. So I think, as I've said, look, there's a lot of takeouts from the US experience. And I think the number one is that, this whole talk around moving to place the client at the very center of your business. Regulators are talking about it, governments are talking about it, we're certainly talking about it in the media. It's not just for altruistic reasons. It's not just for public service and public relations reasons. It's not just because it's the right thing to do morally, which of course it is. It is actually leading to more prosperous firms. And if you have a look at the experience of those US advisors who've succeeded instead of being disrupted in the last 10 years since the financial crisis, it is those that have gotten to know their clients on a more intimate level. It is those that have really reimagined their businesses as financial life managers, as those that are there to help their goals, as really providing peace of mind and psychological support to your clients over the course of their life throughout those stages. And I know that many of you will say that you've always done that. I think if you go to the United States and you see what some of these firms are doing up front, you might realize that it's been taken a little bit further than what you've been doing in some of your firms. And frankly, I think partly it's because our technology in Australia so far, your software providers and so on, have really been focused on investment management. It's all been about financial product distribution. Advisors have historically been, certainly up till very recently, cogs in a wheel, in a value chain that is all about selling financial products. I don't need to tell you that. But the flow-on effect from that has been that the technology providers, who really, of course, work for licensees and the controllers of advice, have had to be focused on this investment management piece primarily. The good ones in Australia are helping you to focus on this client centricity, and I think you're going to see a lot more of that. So really be watching what's coming out of Silicon Valley, be watching things like IBM Watson. I know that you're under time pressures. It can be difficult with all the BDMs that come into your room. It can be difficult to speak to someone slightly outside the box like an IBM Watson. But I think I would advise you to look at how these technologies, particularly artificial intelligence and big data, how they can be used in a cost-effective way on a small scale in your business, and how that can actually lead to a more profitable and certainly a more future-proof business. The other thing I think is a cultural thing. And when you talk to American advisors and Americans in general, they are willing to experiment. They are willing to take risks in their business. They tend to value freedom over security. And I think that's something that we as a culture don't have necessarily, and not in financial services either. We tend to be very risk management focused, and I think that's fair and that's understandable, particularly given the regulatory environment. But I think that experimentation is something that has led to really good quality customer service, and really an uptick in the quality of advice that's been provided in the United States and a resilience for that industry. So that experimentation really coming through, and that embrace of innovation. So be willing to put pressure on your product provider and your licensees to do some of that. Whether or not the traditional licensee survives into the future, we'll leave that as a topic for another day, or the professional association. But really in the US, as I say, these traditional, they didn't have licensees as such in the United States, but non-product provider networks, associations and so on have become less powerful. People talk about themselves as being, I'm a Vanguard guy, I'm a BlackRock lady. You know, they really do hitch their identity to these brands, and it's not because they just think they have good products. It's because they know they stand for something, and because they've helped them master this transition over recent years. And I don't know whether you're ever going to see that in Australia. I don't know whether that's part of our culture to see an advisor describe himself as a Netwealth guy, for example, although I'm sure the company would welcome that. But I do think that you can be leaning on your product providers to provide this sort of community. And if they're not providing what you need them to on the client centricity approach, then make sure they know that. I think that the US is headed through a lot of change. It's already been through a lot of that change. It's going to remain perennially relevant due to the regulatory debates and the consumer trends. I should add as well as a conclusion that I don't think that they're ahead of us in many ways. I do think they're ahead of us on the technology front, but when it comes to our professionalization, our business models, arguably our regulation, although maybe not, we are ahead of where they are. But so I think I'm very bullish on where the financial advice industry goes from here, as long as we're willing to experiment, and as long as we're willing to not be myopic, as Australians can be due to the tyranny of distance, and we're willing to look abroad and see what successful IFAs around the world are doing. And I know that Netwealth will continue to help you do that. So we at Advisor Innovation. Remember to keep reading, and I'm glad to see this hungriness for content. I think that's going to make the difference in the future.
Great, thanks so much, Alex. We've had a question around artificial intelligence. And what software do you know of that firms are already using that's helping them spend more time with their clients?
Yeah, interesting. So whether I know that Nod is one that is really interesting, that is really going in hard on artificial intelligence and tailoring that to financial advisors. And there are others that are sort of, using elements of artificial intelligence. Astute Wheel are doing interesting things that is very much based on the client experience and the user experience, and they're trying to bring it in. But really, in Australia, it is very much at its infancy. Things are going to be slower here. People are nervous about the client experience, around the regulatory system. But I know that IBM Watson are planning to be here in the wealth management space. So I would reach out to them if you're interested and see how they can tailor it to you. The other thing that I would advise is speaking to some of the technology consultants out there, Stuart Bell, people at Netwealth and others who are really clued in to this space, to ask their advice on, really who's nailing this space. So I agree with you. There's a lot of people talking a good game on this. Hard to know exactly where the technology is at. But I do think that you're going to see more of it. And I would ask, I would simply ask, call your software provider and ask him how you're utilizing artificial intelligence and what's your plan on that front. Ring your platform provider and ask them, what are you guys doing when it comes to artificial intelligence? This economist in New York is telling us that if we're not doing it, we're going to be disrupted. So, I have heard of people, but it's difficult as a journalist because when it comes to technology, you very often, sometimes they'll show me a demo, but I'm not the user of this stuff. So I'm very privy to the marketing that comes out. I'm not always best placed to actually know how the technology advice. So similarly to when a consumer asks me what that I would advise them to do, I would tell them to go get good quality independent financial advice. I would advise you to do the same when it comes to artificial intelligence.
Great, thank you. And do you know what percentage of Americans are receiving financial advice in comparison to those in Australia?
Yeah, that's a good question. I think it's around the same. So obviously, we talk about 2 in 10 here in Australia. I think the figures are fairly similar. But I think, what's interesting is that arguably the American industry, the American consumer base, I think, is more engaged with their finances generally. I think there was a bit of a dip after the financial crisis, but I think, really they have regained to some extent. The other interesting thing is the use of robo-advice there, which really hasn't seen a lot of funds under management increases there. They spoke about cutting out the advisor and going direct to the consumer, but that hasn't been the case. The robo-advisors have since pivoted, and they have really become B2B models, aiming their services at financial advisors. So I think that's another sign that consumers are bullish. But the great unwashed out there, it has been difficult for them to engage those people, just like it has been for the Australian market to engage those people. American advisors are talking about trying to go to mass market, and they're talking about using technology to do that. I don't see a lot of Australians doing that, to be honest. Most of the IFAs I talk to post-FOFA are moving away from mass market. They're moving towards high net worth models. And I know that the life insurance reforms have probably paid an impact in that, as has FOFA. So relatively similar numbers of people in advice, but obviously the scale of the market is much larger, and the number of independents is increasing.
Great, thanks. And what are some of the top resources that you can recommend that advisors use to stay on top of what products and service offerings that are out there?
Yeah, so obviously advisorinnovation.com.au is the first one that I'd say, and all of our, IFA.com.au, Investor Daily, as a news provider, we aim to be at the forefront of this sort of technological rollout. Really, I think the role of the media, the business press, should be to be talking about how these technological and regulatory trends globally and domestically are shaping the market. So keep your eye on those service providers, and also be willing to pay for advice. You expect your clients to. I think that your clients should pay for advice. I think that your advice is worth paying for. So I would say that go and speak to them. If you really want to be at the cutting edge, a few resources that I would look at TechCrunch in the United States. Silicon Valley Business Journal is pretty decent as well. But that's really looking at the really top edge stuff. The other thing I would be doing, as I said, call your BDMs. That's their job. Call the people, your technology providers, and ask them, who are you reading, and where do you see the ball going? And they should have an answer for you.
Great, thank you. All right, and that's probably all.
I'll take Shane Mitchell's question there.
Yeah, go ahead.
So we've got time, I think, for one more. The question is, do you see the advisor groups like XYPN, which is the XY Planning Network, being something that can take off here as companies start to get their own licenses? Now, the XY Planning Network is something that I'm pretty familiar with. I've attended a couple of their events. I went to their conference in San Diego, started by a guy called Michael Kitsis, who I would, going back to the last question, definitely recommend his Nerd's Eye view as a resource. He's a financial advisor and a blogger, and really someone who's been a leader of the movement in the United States to a full fee paying sort of model. And really that independent model as well. He also is looking to engage younger people in advice. We've seen XY Advisor, the Facebook group that some of you may be members of, do this a little bit in Australia as well. So already you're seeing that approach on the XY front. But really, I do think that we're going to see a fragmentation. And I think that whether it's caused by regulation and we end up with the Royal Commission recommending and a federal government at some point accepting that we move to mandated individual registration in the form of, the way that lawyers are, I do think that's going to happen at some point. Even if it doesn't, it's already kind of happening anyway due to simple market forces. Businesses in the current environment want to control their own destiny and frankly need to control their own destiny if they're going to have any success of competing on a consumer front with a more engaged consumer base, smarter consumer base. So in terms of the question, I do think we're seeing this fragmentation. I do think like groups like XYPN will play a role. I do think that the more innovative licensees that are currently in the market can survive, even if they're not providing the license itself. But they're going to have to be innovative if they do that. If all they're doing is providing a license, then I don't think they are going to succeed. Advisors are going to want community. They are always going to need that. They're always going to need to have their peers. The media to some extent can provide that. Product providers to some extent can provide that. Whether the professional association can continue to provide that, I think is a very big question, because whether they have been acting in the interests of their own members or acting in the interests of government, articulating government message to their members, I think is a very real question over the recent years. So do keep your eye on groups like XYPN, and also, put your hand up to be a leader and to get involved in the community. I think when that fragmentation occurs, and it is occurring, we will need community and we will need leadership. And I think there are people out there who are thinking the right way about this and will be there to help you do that. So I appreciate all of you listening in. I think we're heading to a better place in this industry.
Great. Thanks so much, Aleks. And thanks to everyone who joined us today. We hope you can join us for our next webinar presentation next month. See you.